A lot of beginners tend to overcomplicate Forex. They think that they need 20 indicators, 10 different monitors, some secret strategy, and years of experience just to place a trade. When in reality, Forex is actually very simple when you understand what you are really doing. Because at the end of the day, you are just buying one currency and selling another. Welcome to episode 2 of my Market Mechanics Mentorship series. In the first episode, I showed you how the market actually moves. Now in this second episode, I want to simplify Forex for you from the ground up. So you actually understand what you are trading, how the different currency pairs move, what even is a currency pair, and how money is made or lost in the market, what's the best time to trade, how to pick a different trading style. Basically, I'll walk you through everything you need to know about Forex trading. With that being said, let's get right into it. So, what is Forex? The term Forex basically stands for foreign exchange. The foreign exchange market is the global marketplace where the world's currencies exchange hands at a mutually agreed rate, exchange rate. This exchange rate changes every single second, so the market is constantly fluctuating. So as Forex traders, what we are pretty much trading is this exchange rate. We are betting on whether it's going to go up or down, and then we are trying to make money off our bet itself. That's it. The Forex market is the largest financial market in the entire world, with a daily trading volume of $6.6 trillion. Not $1 million, not $1 billion, but $1 trillion with a T. It is also 200 times bigger than the largest stock exchange, which is the New York Stock Exchange. So there's a lot of trading volume, which means there's a lot of market participants, which also means there's a lot of liquidity, a lot of trading opportunities. So the market is open 24/7, right? So unlike the stock market, which is only open when the stock exchange is open, the Forex market is open 24 hours a day, 5 days a week from Monday to Friday. So it's only closed during the weekends. So Forex trading is pretty much the conversion of one currency into another. That's it. So an example, you travel from Singapore to Australia, and you cannot be using Singapore dollars in Australia, right? So as a result, you will go to a nearby currency booth at the airport, and then you will exchange your Singapore dollars into the Australian dollars. And with that exchange, there's an exchange rate, right? For example, 1 Singapore dollars equal X amount of Australian dollars. And what we are essentially trading, like I mentioned earlier, is the exchange rate. Forex markets are always quoted in currency pairs. The base currency is on the left of a currency pair, while the quote currency is on the right. The base currency is always equal to 1, and the quote currency is equal to the current quote price of the pair. This means that the price for a pair is how much of the quote currency it costs to buy 1 unit of the base currency. So when you trade Forex, you are essentially buying one currency while selling the other. For example, in this example, it shows EURUSD equal 1.35361. Euro is the base currency. USD, US dollar, is the quote currency. So what this means is that it would take 1.35361 US dollars to purchase 1 euro. This is the exchange rate. So yeah, this is something that you have to know, because every single currency pair, it comes in pairs, right? That you can't just buy or sell like Euro or USD. If you are trading Forex, you are going to be dealing with currency pairs, right? They come together. So once again, that's just how the market works in Forex trading, right? So when you go on to Google and you search up how much convert Euro to USD, that's the exchange rate, and that's what we are trading. When you buy EURUSD, what you're doing is that you're expecting the price of Euro to rise. So you buy Euro, which is once again the base currency, and you sell USD, which is the quote currency. So if the Euro strengthens against the USD, you make money. That's it. And if you sell Euro USD, what you're doing is that you're expecting the price of Euro to fall. So you sell Euro, which is the base currency, and you buy USD, which is the quote currency. So if the Euro weakens against the US dollar, you make money. That's just how the market works, right? That's just how Forex trading works. So when you buy a pair just like this, you are predicting that the base currency is going to go up and the quote currency is going to go down. And if your prediction turns out to be right, you make money. If you sell, then you are literally betting that Euro is going to go down, USD is going to go up. Remember, for one currency to go up, there will be another weakening against it. All currencies cannot go up at the same time. Just like in life, there is always going to be a winner and a loser. Forex traders weigh up whether a currency looks likely to strengthen or weaken against another, and then they trade that pair accordingly. So if I think Euro is going to strengthen against against US dollar, this is where I'm going to be buying Euro USD. If I think Euro is going to weaken against the US dollar, I'm going to be selling Euro USD. So who trades Forex? There's a few market participants. Number one, we've got the big banks and large financial institutions. These are the whales, right? These are the people who are trading with millions or if not billions of dollars. They have a lot of liquidity, they have deep pockets. And then you got the central banks and government. You even got large commercial companies, because you must understand that when companies they are paying their employees overseas, they might want to convert their salary into that particular country's currency before paying them out, right? So simple things just like this means that they are essentially still participating in the Forex exchange, right? The Forex market. And also you got the retail traders, which is us. Right, so these are the market participants. These are the people that are playing in the game in which you are playing. So if you do not understand the game, you are going to be losing to the people who does, which is the big banks, the large financial institutions with deep pockets who technically control the market. Now, how do you know when to buy and when to sell? How do you know whether the market is going up or down? You don't. The truth is, as retail traders, we cannot predict with 100% certainty where the market is going to go. And the best part is that we don't have to in order to make money. You heard that right. You don't need to predict what's going to happen next in order to make money in this market. Because trading is simply a probability game, which means that every trade outcome is random. However, we can increase the probability of us winning a trade, of us predicting where the market is going to go, by developing an edge. An edge is what separates winning traders from losing traders. That's all an edge is. An edge is not a guarantee you will win a trade. An edge is not a guarantee that price is going to go up just because you predicted it to be. It's just something that puts the odds in your favor. Most beginner traders, they don't even have an edge. And as a result, they are not able to get consistent profits. They might make some money here and there because of beginner's luck, but they find it incredibly difficult to profit consistently. But once you master the 3 M's and you start to focus on the process rather than the outcome, this is where you can transcend from the randomness of the market and start making consistent profits. I'm going to talk about the 3 M's in a bit. But that's all an edge is, right? Your edge is basically your trading strategy that allows you to make more profits than losses. That allows you to make more money when you are right, then lose more money when you are wrong. That's it. And in order for you to develop an edge, you need to master these 3 M's. In order for you to achieve consistent profitability, you need to have these 3 M's in your arsenal. And that is method, which is having a profitable trading strategy that works in every market condition. Money management, which is the ability to take trades with high risk to reward ratio while keeping your risk consistent. To put it in plain English, is to basically make more money when you are right compared to losing when you are wrong. right? So make more money when you're right and lose less money when you're wrong. So the wins, the profits are always outweighing your losses. And then you need mindset, right? The ability to execute trades based on mechanical rules on your trading system rather than emotions. So those are the 3 M's. And over the next 30 days, throughout this entire Market Mechanics Mentorship series, I'm going to be teaching you everything you need to know to build a profitable trading strategy, manage your risks, and develop the mindset of a professional trader, a profitable trader. So yeah, we're going to have lessons that is catered towards each one of these core pillars. And once again, you need all 3. Just like a stool that you can see on the screen right here, if you take one leg away from the stool is going to fall. You need all 3 legs to become consistently profitable. You need method, money management, and mindset. Now let's take some time to talk about currency pairs. Currency pair is basically a price quote of the exchange rate for 2 different currencies traded in the Forex market. And all currencies are identified by its own ISO currency code. Here's what I mean, right? So, for example, the Great Britain or England, their currency is the Great Britain pound, which is in short GBP. And then for the Japan, which is using Japanese yen, their currency code is JPY, Japanese yen, Great Britain pound. And then for the US, they are using the dollar, which means it's US dollar. So this is their own individual ISO currency code. Every single country has one. Now, there are 3 types of currency pairs. There's your major currency pairs, your minor currency pairs, and your exotic currency pairs. Major currency pairs are the currency pairs that include the US dollar. So I'm talking about Euro USD, GBP USD, NZD USD, USD JPY, USD CHF, USD CAD. So this is the Euro USD, the Great Britain pound US dollar, the New Zealand dollar against the US dollar against Japanese yen, the US dollar against Swiss franc, the US dollar against Canadian dollar. And then you got the minor currency pairs, which is pairs that include any 2 of the major currencies except the USD. So minor currency pairs do not have USD inside. So it's stuff like Euro JPY, Euro Swiss franc, Great Britain pound Australian dollar, Great Britain pound Japanese yen, Australian dollar against the Canadian dollar, and Australian dollar against the Swiss franc. And then we got the exotic currency pairs, which is the pairs that include 1 major currency and 1 currency from emerging markets. Now, for the majority of you guys watching this, I would advise you to just stay away from exotic currency pairs, but it's good for you to just understand what they are. Just to give you some example, US dollar against the Singapore dollar, US dollar against the Thai bahts, US dollar against the Hungarian dollar, US or Australian dollar against the Mexican pesos, if I'm not wrong, correct me if I'm wrong, but the Canadian dollar against the Singapore dollar, right? So yeah, those are the list of some examples of the exotic currency pairs. And to be honest with you, I don't even know like them because I don't even touch them throughout my entire trading career. I've been trading for like 7 years right now, and never have I ever traded a single one of these exotic currency pairs. So yeah, you're much better off just staying away from them and sticking to the major currency pairs. All right, so for my beginners out there, you want to stick to the major currency pairs because these are the currency pairs with the most amount of liquidity, volatility, and trading opportunities. So I'm talking about Euro USD, GBP USD, NZD USD, USD JPY, USD CHF, and USD Canadian dollar, right? So yeah, stick to this and you'll be good. And my advice for you is to experiment with all the major currency pairs. If you don't know what to choose, try all of them. Try different flavors. Try Western cuisine, Japanese cuisine, Australia cuisine, Turkish cuisine. Try everything and then see what you like. And then once you have found out what you like and which one is the best for you, you want to stick to 1 to 4 currency pairs, right? So I would advise you to have like maximum 3 to 4 currency pairs on the watch list. So if one currency pair doesn't offer you opportunity, you can switch to another one. And if that one doesn't, you can switch to another one. Yeah, so you can have multiple, right? But at any given moment, you should only focus on analyzing the charts of one currency pair. Okay. Next up, let's talk about some Forex language and lingo, which is some terminologies which you might not be familiar with, that is exclusively for Forex traders. Okay, so this is like the language we actually use as Forex traders. So it's like speaking a different slang, speaking a different dialect, right? So you need to understand these terms, because if not, you will not be able to communicate with other Forex traders, and you will not be able to understand the terms that your Forex trading platform and broker is using. Number one is pips. Now, what is pips? A pip stands for percentage in point, and it's the smallest price movement any exchange rate can make. It measures the amount of change in the exchange rate for a currency pair in the Forex market. And a pip is basically the fourth number after the decimal point, right? So in this case, this is the decimal point. 1, 2, 3, 4. This is a pip, right? So it's the fourth number after the decimal point. And pips is basically what allow us to know how to calculate our profit and losses as Forex traders. All right, so if you look at this case, in this right here, EURUSD, right now the exchange rate is 1.0926, which means that this right here is the pip, right? So once again, it's the fourth number after the decimal place, except for Japanese yen pairs, which I'm going to talk about later on. And in this case, if the price of EURUSD goes from 1.2468 to 1.2470, you can see what changed was this right here went from 68 to 70. What just happened is that we just made 2 pips, right? We just gained 2 pips. All right, so 2468, 2470, you can see the difference is 2 pips, right? Because the only thing that changed was this last number right here. Another example, 1.2576 to 1.2566. This time around, price went down by 10 pips, right? Because 2576 minus 2566, the difference is 10 pips. And then next, you got 1.2176 to 1.2276. This time round, which number after the decimal point actually changed? It was this one right here, which is the 100th pip. Okay, so if this is the pip, this is the 10th pip, and then this is the 100th pip. So in this case, if it changed from 1.2176 to 1.2276, the difference is 100 pips. So that's just how the math works in the Forex world, right? If you don't understand this, don't worry. As with more practice, you will get more familiar with it, right? Just like a language, the more you speak the same language, the more you well versed you can become at speaking that particular language itself. So yeah, don't worry about this. Just know that this is how we calculate like the pips, right? This is how we calculate the dollar move in Forex. And like I said, the pips works a little bit differently on Japanese yen pairs, because Japanese yen pairs only go out to 2 decimal places. So 1 pip is the second number after the decimal point, right? So in this case, it will be this one right here, right? 1.70.67. If it goes to 170.68, then guess what? We just plus 1 pip. As simple as that. If it goes to 170.77, then we just plus 10 pips, right? The difference is 10 pips. And then we got the pipette, right? Which is this small little number that is attached to the entire exchange rate. This is the pipette, right? This is the micro pips. This is 1/10 of a pip, right? So yeah, if this is the pip, this is 1/10 of the pip. So 1 pipette equal to 0.00001, right? So if price move from 1.09263 to 1.09265, guess what? We just plus 0.2 pips. We just plus 2 pipettes. Okay, so yeah, it's just this small number that is attached to the exchange rate itself. Next up, we got lot size. Lot size is like the amount of units of a certain currency pair you're going to be buying or selling. Because in Forex is traded in lots. A standard lot is equivalent to 100,000 units of the base currency. This is $100,000 if you were trading in US dollars. And every time price moves by 1 pip, you are making or losing $10, right? So it's $10 per pip. Now, mini lot is 0.1 lot, and that is 10,000 units. Every time price moves by 1 pip, that's $1 per move. And micro lot is 0.01 lot. And if price moves by 1,000 units, this is where you are making or losing 10 cents. Okay, so that's the lot size itself. So I'm going to show you how to combine the lot size and the pips to calculate your P&L later on. But for now, just understand that when we're talking about lots, we are talking about the units in which you want to buy or sell a specific currency. And here are some other terms that I want you to familiarize yourself with. Bullish basically means you expect price to increase. So if I say I'm bullish, I'm expecting price to increase and I'm going to look for longs. I'm going to look to buy. If I'm bearish, that means I'm expecting price to fall. If I say I want to enter for a long position, it means I want to enter for a buy order. If I want to enter for a short position, it means I want to sell. And then you got stop loss and take profit, which is how you exit a trade. Right? Stop loss is pretty much, if you place a stop loss at a certain price point, that means you want to close the trade at that particular price if the trade does not go as planned. What if the trade goes well? Then if that's the case, you want to set a take profit, which is a profit goal that once you hit, you get out of the trade if the trade ideal went as planned. Now let's talk about how you make money in Forex trading. You do so by correctly predicting a currency pair price movement. Opening a position that stands to profit. Example, if you are bullish on euro, right? That means you're thinking euro is going to go up. It's going to strengthen against the US dollar. As a result, you're going to buy Euro USD. Okay? Because once again, you are betting that euro is going to strengthen against the US dollar and price is going to go up. And then later on, a few minutes later, a few hours later, Euro USD did go up. So your trade ideal went as planned. As a result, you make money. If you're bearish on the Great Britain pound and you sell GBP USD, once again, betting GBP USD is going to go down. And later on, GBP USD does go down. The Great Britain pound does weaken against the US dollar. You make money. That's it. And now let's talk about the math behind it. How do you actually quantify the P&L? How much money can you potentially make or lose on any given trade? Well, it's determined by your lot size, which is the amount of units that you're purchasing or selling, and whether you enter for a buy or sell, and however much does it go up or go down, which is determined by the pip distance. Now, let's look at that example right here. So, once again, this is how you determine however much does a particular currency go up or go down. Is by looking at the pip difference and also the lot size itself. All right, so those are the two concepts. So let's look at an example. If you buy Euro USD and right now Euro USD is sitting at 1.250. Once again, you're buying Euro USD, that means you are thinking that Euro is going to strengthen against US dollar. So if Euro goes up, you make money. And then let's say later on, after you enter for the long position, Euro USD went up by 10 pips. It moved from 1.2500 to 1.2510. So as a result, guess what? You have potentially just made 10 pips. But how do you turn that into P&L? Right? To determine how much money have you made on this trade itself? Well, the next thing we look at is the lot size, which is the amount of units that you have purchased. So in this case, let's say the lot size you used was the one lot, the standard lot, which means you have essentially purchased 100,000 units of Euro USD. So 100,000 units of USD and price moved up by 10 pips, and every single time price moved by 1 pip, that is $10. You take 10 pips, which is however much it went up by, times $10 per move, right, per pip move, and you get $100 itself. So it's basically your lot size, the amount of units, times the dollar per pip move. And that is how you calculate the profit. Now, if you don't understand, let me just give you like a quick example. Okay, so in this case, let's say same exact scenario right here, guys, right? You enter for a buy, price also moved by 10 pips, but this time round, instead of using one lot, instead of using a standard lot, you only use a 0.5 lot, which is half of a standard lot. So as a result, you can expect your profit to half. So instead of making $100, you are making $50 because you use 0.5 lots, right? Which is essentially you are entering for a buy for 50,000 units of your USD, and every time price moves by 1 pip, that is $5 per move, and you take $5 per move times the amount of pips which the move actually entailed, which is 10 pips, and you made $50. Now let's do another example just to reinforce your understanding of this. Let's say you sell GPUSD. Right now GPUSD is 1.2828 and price went down by 20 pips. Okay, so you can see price went down from 2828 to 2808. So in this case, the lot size you use is 0.2, right? Which means you are just selling about 20,000 units of GPUSD. And every time price moves by 1 pip, that's $2 per pip. So this is where you can calculate your lot size, right? You can calculate your loss and you realize that you actually lost 20 pips. Wait, if you are selling and price did move down by 20 pips, there's a mistake right here. You are actually making money. Okay, so in this case, if you actually entered for a buy instead of a short, this is where you will incur a loss of 20 pips and times $2 per pip, that is $40. All right, so there's a mistake right here. Just change this and replace it with buy. So if you went for a buy for GPUSD and the market moved against you by 20 pips, and you take that times the dollars per pip, this is where you will lose $40. As simple as that. So this is the formula that you can use, right? Which is pip movement, which is the pips, times the position size, which is the dollars per pip, and that is where you get your profit and loss. So that's how you can calculate it. But don't worry, because of the modern age, we got a lot of tools and softwares that help you with identifying the pip distance. So this shouldn't be a problem whatsoever. And also with more practice, you will get a hang of this. Now, next question that I get quite often is, what time should you be trading Forex? Like I've shared with you earlier on, the Forex market is open 24 hours a day, 5 days a week. But not every hour has good movement. Not every session gives you clean setups. Timing matters a lot in trading. The Forex market have 3 main sessions, right? There's the Asia session, which is a combination of the Sydney session and the Tokyo session. And then you got the London session, and then you got the New York session. And each session has the different personality, different speed, different level of volatility. The Asia session is usually much more slower. There's going to be lower volatility. Price can stay in consolidation for longer, and it's like less active overall. So this session right here is not really ideal for beginners who is looking for strong move. And then got the London session, which is one of the most active session. This is the strong trading volume enters the market. This is where you can expect much more cleaner move, much better trading opportunities. And it's a great session for many major currency pairs. I specialize in this session itself, right? Just to show you that. To me, I really believe that this is one of the best sessions if you want to trade profitably. And then you got the New York session, which is also very active, right? It brings about strong volatility. And this is also a session where a lot of high impact news tends to happen. And this could be another key session that you might want to pay attention to. Now, the next question becomes, which is the best time to trade? Now, in my humble opinion, I believe that the best times to trade are usually when the trading volume is the highest. And this is usually occurring within the London session or the New York session itself. The reason why I want to trade when there's more trading volume is because more trading volume means more liquidity, means better price movement, means cleaner setups, means more predictable price movement, and also more trading opportunities. So a big mistake that a lot of beginners tend to make is that they try to trade all day. They wake up, they start trading at 9 a.m., then they trade all the way to 9 p.m., and then they go to sleep, they do it all over again. When you do this, what happens is that you tend to become tired mentally by staring at charts all day. And not only that, the hidden cost of doing that is also over trading, which means you could enter and make money during the Asia session, and then during the London session, you continue trading, and then you start getting lost and directionless, and now you give back the money that you have made in Asia session during the London session itself. So yeah, you don't need to be at the charts all day to be profitable. A much smarter trading approach is to find one specific window and just focus on that window. Whether that's the London session, the Asia session, or the New York session, but just stick to one. And you want to pick the trading session that fits your lifestyle. And once you do that, you want to learn how price behave during that time. Get really, really good at trading your specialized currency pair in that particular trading window. So next up, let's talk about the different analysis in Forex trading. There's 3 types of analysis. There's your technical analysis, fundamental analysis, and sentiment analysis. Technical analysis is the chart work, right? It's basically the starting of past price and volume data. It's the ability to analyze charts to identify trends or patterns. So this is where we pretty much implement market mechanics, where we look at a chart and try to predict where price is most likely going to go based on the price action. So technical traders will often analyze the historical price data on the charts to identify trends or patterns which will help them predict future market behavior. And then you got fundamental analysis, which is the study of underlying economic and financial news and announcements that might impact the market. And there's a lot of different factors that actually influence how and why price move, and that is stuff like monetary policy, interest rates, inflation, gross domestic product, non-farm payroll, Federal Open Market Committee, any comments from Feds and central banks, economic chaos or prosperity, war, right? Widespread pandemics like the COVID-19 pandemic. All of this stuff actually causes the entire sentiment of the market to change, which causes the price to actually move, right? So for sentiment analysis, we are actually gauging how the general public feel about something. And this is where we like to analyze people's emotions, opinions, and attitudes, where we look at social media, where we look at reviews, where we look at articles, right? For example, right now, because of the World War III that is going on right now with Iran and the United States, there's a lot of fear in the market. So if we know that, then that is where we can expect the prices of stocks, other commodities, for stocks and other assets, more risky assets like crypto to start falling. And then we can expect prices of oil to actually go up, prices of gold to actually go up, right? So that's pretty much using sentiment analysis, using the sentiment of the market to kind of predict where price is most likely going to move based on how the general public feel about that particular asset. Next up, we got the different trading styles, right? So these are the different trading styles that you can adopt as a trader. You got your scalping, you got your intraday trading, you got your position trading, and your swing trading. Scalpers are pretty much people who are getting in and out fast, right? Anywhere from a few seconds to a few minutes, basically less than an hour. And they are targeting a small amount of pips. And their entry time frame will probably be like the lower time frames. And then for intraday traders, these are people who are entering and exiting the trade within 24 hours, right? So this is where they tend to target a little bit more. They tend to target 10 to 100 pips. And then you got swing traders, who are people who are holding the trade for days or even weeks. And since they're holding the trade for so long, you can expect them to target like a much more significant amount of pips. And then you got the position traders who are like, not really like long-term investors, but also not really like swing traders. But these are the people who are holding the trade for weeks or even months, right? So they can expect them to target a lot more pips. Now, which one should you choose? Should you be a scalper? Should you be an intraday trader? Should you be a swing trader? It depends on these three things. It needs to fit into your schedule, right? So if you're working a 9-to-5 job and you find it hard to scalp, you find it hard to concentrate on the charts and stare at it for like a few hours after work, then you might be better off opting for intraday trading or even swing trading. It needs to align with your goals. Okay, so based on what you want to achieve from the market, based on your desired outcome, you want to choose your trading style that fits with it. For example, if you want to be a person that want to travel the world, enjoy life, then perhaps swing trading is perfect for you. You can enter a trade on Monday, check the charts here and there throughout the week, and then get out on Friday. You don't have to stare at charts all day like a scalper, right? So align the trading style with your goals. And last but not least, you want to find a trading style that suits your personality. If you're someone that's more calm, more relaxed, you don't like to stare at charts all day because it's quite stressful, go for swing trading. If you're someone young who likes the adrenaline, who likes the excitement, who is very impulsive, right? Who's very aggressive, who has a high risk tolerance, you might want to go for scalping. So based on these three criteria, ask yourself which is the trading style that suits you the most. And then that's the one that you want to pick. And I will always preach the importance of just experimenting with everything, right? Like I said, try the different cuisines, see which one you like best. And then once you try all of them out, then you can define which is the one trading style that you want to focus on, and then just continue to get better at mastering that particular trading style itself. And a lot of you guys might have seen me catching these high RR trades, right? Where I'm catching 1-to-10 R trades, 1-to-8 R trades, where I'm, making $8,000 when I'm only risking $1,000. These are what we call sniper entries. These are high risk to reward trades. And you can only catch this if you are either very good at entering and exiting trades, or you have a hybrid approach, which means you use the entry timeframes of a scalper, but you use the higher timeframes of an intraday trader, right? So as a result, you are able to enter, get all these tight stop loss, and able to target a zone that is on the higher time frame itself. So once again, we're going to cover more about this later on, but if you want to catch these high RR trades, it's going to be much easier for you to do so if you have more of like a hybrid approach, like a scalper and also an intraday trader, or also like a swing trader. Next up, let's talk about choosing a trading broker. Now, a broker, which is basically a company or a firm that helps you execute your trades. So when you're choosing a broker, you want to look for the following criteria. It needs to be licensed and regulated. It needs to be at a safe and secure location. You need to be able to withdraw your money as and when you wish. It needs to have a quality customer support which is able to help you out with your queries and your doubts. It needs to have low trading costs. It needs to have a minimum deposit and also leverage. And it needs to offer a platform. So when it comes to broker, my best advice is do not use a broker because your favorite trading guru asks you to do so. Be it me or someone else on YouTube or Instagram, don't just use it because they promote it. Always do your own due diligence because it's your money, which is your responsibility. The last thing I want to happen for you is you trust your hard-earned money with a broker and then the broker runs away with your money. The broker doesn't allow you to withdraw your money, which is ridiculous. So I personally recommend 8cap because you have super tight spreads. It allows you to execute trades really, really fast. You have deep liquidity. You have educational resources, which is really good for beginners. It has an economic calendar and it allows you to stay informed, right? So once again, this is just my personal recommendation for you. Still go and do your own due diligence. If you feel like 8cap is the one for you because it's licensed, regulated, it meets all the criteria that I just mentioned, then by all means go and create an account with them. And when in doubt, you're much better off just sticking to the safest brokers out there, which is the ones that you can see on the screen right now. So here's my execution process. I tend to connect my broker to a trading execution platform like MetaTrader or CTrader. And then once I do that, I will analyze the charts on TradingView. And then once I develop my trade bias, whether I want to enter for a buy or enter for a sell, I like to execute my trades on either MetaTrader or CTrader, which is the trade execution platform. Now, here's an optional step. You can also connect your trading account, your MetaTrader or CTrader account, to a trading super app like Edgeflow, so you can plan, execute, journal, and review your trades all in one place instead of juggling 10 different apps just to trade. Edgeflow is a trading super app that I personally built to help retail traders trade in a much more disciplined manner so that they can actually achieve consistency and they don't have to waste their time, spreading themselves thin by using different apps to journal, calculate their lot size, review their trades, and execute their trades. Instead, you can have everything in one place. Link in the description. Now, the reason why I wouldn't recommend you to connect your broker to TradingView is because you might rush into trades without thinking through properly. You might enter into buy and sell orders or manage your open trades accidentally. And most importantly, you will get emotional when watching your profit and loss fluctuating as you analyze the charts. Now, let's briefly talk about trading costs. Your broker makes money based on your trading volume. They want you to take as many trades as possible and take them as often as possible. Because of this, right? You got your BNR spread, you got your commissions, you got swap or carry or rollover fees. All of these are the fees that you will incur if you are actively day trading. The BNR spread, for every buy order, there must be an equivalent sell order for a trade to take place. Bid price is basically the price that you sell to the market. Ask price is the price that you buy from the market. And the difference between the bid and ask price is your spread. So this is why a lot of times if you enter for a buy, you will almost immediately get into a drawdown. You will automatically lose money. You will automatically be down like $100 even though price is not moving against you at all. It's because of this. It's because of spreads. So in this case, you can see the bid price is 1.3885. And then the ask price, which is the price that you buy from the market, is 1.30870. So as a result, the difference of this is 1.5 pips, right? And that's the spread. So if you enter for a buy in this case, you will immediately be in a drawdown of 1.5 pips, which is the spread. Because if you want to get out of the position, you have to sell at the bid price. Next up, we got a commission, which is usually fixed amount per trade by the broker. Example, $7 per lot on each trade. And round trip, which is 2 trades, right, which means you buy and sell or vice versa, you're essentially paying $7, $14 in commission in this case itself, right? So if you actually enter for a buy the first time round, right, and this is where you will pay $7 commission. And you enter for a sell, this is where you pay another $7 in commission. So the total commission cost for trading one lot on EURUSD is $14. So this is like a fixed amount that your broker charge. And then you got your transaction cost, which is the commission plus spread times the bid value, right? So this is an example on how you can calculate it. Once again, I'm not going to go too deep into this because this should be explained on your particular broker, and they should make it very, very clear on what's their transaction cost. And you want to make sure that you pick a broker with low transaction costs. Swap, you got the rollover, right, which is moving open position from one trading day to another. And swap, which is the fee that you have to pay if you hold your trades overnight. And this only apply for swing traders or position traders because these are the people who are holding the trade overnight. And this is calculated by adjusting the closing level of your open position with the interest rates of the currencies involved. And the rates can change daily as they are based on the underlying market price. If you buy currency with higher interest rate, you receive interest. If you buy currency with lower interest rate, you pay interest. And this payment is known as the carry. So for example, if you buy one lot of EURUSD and the current price, bid and ask price is this, after 24 hours, the bid and ask price change to this. Now for you to roll over your position, right, which is holding the trade overnight, you're going to be selling at 1.1378 and then buying back at 1.13805, which means you will have to pay the difference, which is the 2.5 points. And if you take that times the dollars per pip, right, which is $10 since you're buying one lot, the swap fee is $25. Yeah, so all of these are the costs that you have to incur as if you're trading with a broker, and these are fixed costs. It's like the cost of doing business. You can't really avoid them if you're a trader. All you can do is to find a broker that have very low fees so that you can minimize like the amount of money you actually give to them so you can save more profits for yourself. My advice is don't worry too much about the transaction costs, right? I know, this can be quite alarming. You need to pay quite a lot of money. All of these little costs add up. But in the long run, over the grand scheme of things, I would say it's pretty worth it since you are going to be making a lot more money than what you're paying to the broker itself. Like I said, you're much better off just finding a broker that offer you low transaction costs and fees and just stick to it. So now that you understand what Forex is and how trading actually works, the next step is to learn how to read the chart itself. So in episode 3, I'm going to break down market structure and show you exactly how to tell whether the market is bullish, bearish, or simply pulling back. And this is where you can learn how to develop your daily bias to determine whether to buy or whether to sell. So yeah, next lesson, we go back to the charts, we get away from the slides, and we delve deeper into market mechanics. So if you guys have enjoyed this longest lesson, please go and like and subscribe so that you can get notified when the next episode of this Market Mechanics Mentorship series actually gets released. And I look forward to seeing you guys in the next episode. And as always, remember, you're just one trade away. Mwah.